Puppies. So this is Cinnamon here. She's a Springer Spaniel and she's a puppy about 10 weeks old. Everybody has different things they want to, have in their lives. And for us, we love animals and we, have a lot of clients who love animals too. And so, it is something that's expensive. It's a luxury item, but it does bring a lot of joy and a lot of love to us as a family. And again, they can be great companions. I know the first puppies we got for you, son, you were about 5 years old, and it was raining, and you were home from kindergarten sick, and we went out and got two little puppies, and that was quite a few years ago. And this time I had to go on my own, but with my mom, actually, I needed two people to help me, can corral these little nice little puppies. I'm going to set her back down. She can go back to work in my office. They're still eating that darn box. I'm going to have to do something about that. Now she's onto the shredded paper on the floor and tissues out of my trash. But I digress. So property insurance, what do you want to talk about?
Well, first off, just to give a little bit of background. So it was Christmas, right? And we decided that the best gift for our family would be to get some puppies. And so my dad, self-sacrificially decided that it'd be a good idea to go up to Oregon from where we stayed in California, in the middle around Fresno area. And it was actually Bass Lake. And so he drove on over, went on up with his mom, had a great time with her. They are best of friends, and there was no drama. And it's just a very perfect relationship right there. But obviously, she'd wanted one of the puppies before 15 years ago, and she elected not to get them. And I think that was a wise decision because we ended up with two of them, just like we have now. And basically, he came back down and flew with them, and now he has to deal with them in his office. So during this podcast,
I don't know if that was a good idea. But at any rate, these are the fun things in life, right? Making sure your puppies don't.
Puppies, right? Maybe some family in there, and then property insurance, I'd probably say. Top three?
Everybody thinks property insurance. You kidding me? I mean, probably puppies, family. I think insurance is third. I mean, honestly, that's what people think, I think. Don't you?
No. I'd be surprised if it wasn't one on everybody's list. But pretty much, okay, property insurance. Speaking of puppies, I think it's topical to say, some owners, if you are renting a property, they do require the insurances at least have an understanding of the breed and that they're not a bite risk. As a landlord, also, it's important to note that, talk to maybe your broker about that because there might be some exclusions on policies and claims and liability if there were to be an event where a dog that was a excluded breed on a policy were to bite somebody, God forbid. But obviously, I mean, if you own properties and you're the owner of a property and you live there yourself, you kind of got to pay.
We've actually had a dog bite claim. I don't know if I told you the story, but we had a good client, pretty wealthy individual. A mailman his dog went out the gate, and the mailman had a bag. He was carrying a bag, and he swung the bag around between him and the dog decided to play tug-of-war with the bag. And then the mailman, or the person, decided to pull back on it and try to play tug-of-war with the dog. But he was afraid of dogs because a lot of male people have been attacked by some pretty aggressive breeds. So I don't blame the guy, but he ended up tripping and falling, and I think it was $200,000 claim. So these claims do happen, and having a dog is a big responsibility. Speaking of that right now, they just tore a piece of that box off. So I'm going to have to cut this one short and go take care of them, okay? We'll get back to it. Or you keep going. You talk.
Yeah. Okay. So I'm going to talk in the meanwhile while Brian deals with the puppy cleanup situation. Hopefully it'll only take a couple minutes, so you guys only have to listen to me for a couple minutes. But we wanted to start off talking about property insurance today. Particularly, I think we're going to emphasize in the beginning homeowners policies. So usually an HO3 policy. HO6 is for condo owners, but HO3 policies are very important to understand the coverages of. And so it depends on, the coverage. At least the biggest one is coverage A. And so dwelling coverage is that coverage A. And if you're a property owner, it's very important to have an accurate coverage A, right? So replacement cost is basically the cost that it would cost to replace that property in the event of a complete loss, right? So the Palisades fire, if those, obviously a lot of homes burned down tragically, then in that instance, we would have a replacement cost estimator, hopefully before the fires, have, properly covered that property and estimated how much it would cost to replace that property. If you actually have an actual cash value replacement cost, that's completely different. And so it's important to understand these things, talk to your broker, understand your coverages, because obviously the biggest thing with insurance is making sure that you have enough coverage, right? I mean, obviously you might be worried about the pricing and things like that, but usually we only see a couple $100 difference maybe with, depending on the policy, actual cash value replacement or actual replacement cost of the property in the event of a loss. So I think those are very important things to understand the distinction between. And let's talk about the other coverages, right, Brian? What about medical payments? What about, premises liability? Premises liability.
Well, just to add to what you said before, I don't know, I didn't hear it all, so I apologize. But extended replacement costs on homeowners policies, get the most out of that you can. A lot of insurance companies, like I feel like State Farm underinsures, one of our homes, actually all of our homes. But that extended replacement cost, that extra 50% does help. It may not be quite 100% enough. The way I'm looking at it is I'm still going to get a new home. I'll probably be able to figure it out. Again, hopefully my house will never burn down is the third thing. So it is a game that people play, and insurance companies, I feel like, are a little behind the curveball with all the inflation we've had. Now, you were just talking about MedPay is what you're talking about first?
Well, let's talk about medical payments. What does that mean, right? So, I mean, obviously, in a property insurance policy, you'd think it would just cover, the property, the things in it, maybe, right? But what are medical payments? What does that imply?
Well, MedPay is part of that liability aspect of those policies, right? So MedPay basically is like a third party. Somebody goes to your house and trips and falls and, breaks their leg, cuts their leg, whatever. Instead of them having to sue you for $50,000, $100,000, $1 million, you can get like usually $1,000 to $20,000 of MedPay, and it's kind of like a no-fault kind of coverage that allows them to kind of, give them the deductible, give them a little bit of money. Not enough that they're going to sue you forever, but it helps to offset the medical payments, and a lot of times that's what people really want anyway, especially if they're your friends or family. Nobody wants to be suing their friends or family.
Yeah, it's obviously it's a very teeny coverage. I mean, when you compare it to some of these, dwelling costs, but it is a very important coverage to have, right? I mean, so if somebody were to be delivering something inside your house, like a TV, right? So we just got a TV delivered to our new place, right? And it was from Costco, so don't worry. But the delivery guys, they came in. I mean, obviously something could have happened, God forbid, where they were to get hurt, right? So would that be covered by medical payments?
That's an interesting question. I don't think so, and here's why. I think in that case, they're actually employees of the other company, the delivery service. And a delivery service should really have their own coverage. Yeah, it could be their workers' comp policy probably should be paying for it. Now, that's where it gets into contracts, though. We talk about this with our contractors all the time. That waiver of subrogation means even if you left something out and they tripped over a briefcase or, a rug or something like that you had in your house that they weren't aware of, that waiver of subrogation means that they can't sue you even if you were negligent. So waiver of subrogation is a really, really big thing, especially on workers' comp, but really all liability forms.
Yeah, all liability forms. I mean, emphasis on workers' comp, but, as a personal person, right, I mean, who has his personal property, right, I mean, it's important to...
And a renter's policy, too, just in case.
Oh, yeah, AAA in California, for renters policies. I don't know if we're the specialists at the renters policies, but at least AAA,
they're harder to get. Like, that used to be something that companies like Mercury offered really cheaply.
So independent brokers like us would be able to help people with renters policies, but now it's more...
It's harder. It is harder. I mean, for friends and family, maybe, we can help. But again, mostly it's the bigger stuff that we can help with. And again, it's gotten more difficult to do that. Again, it's just
leave it to the specialists, right? High volume, right? Because there's a lot of renters policies, especially in Los Angeles and in California. And so it would be too much for us to have to, help everybody with the renters policies, obviously. And, we definitely wouldn't be able to offer as competitive pricing as these bigger ones who do have, like you say, the law of large numbers on their side because they're insuring so many in a specific area. But let's go to premises liability. What's premises liability versus medical payments? I mean, liability.
So medical payments is somebody gets hurt at your location. It's kind of like that, right? It may be a subset of premises liability. Premises liability, though, is more like somebody wants to sue you, right? So they want like pain and suffering. They want medical payments in addition. They want more than just kind of a no-fault kind of like, hey, just help me with my medical bills. Yeah. So that's kind of the difference. Is I think of it like a ladder or like a stairs, right? You got MedPay kind of here, and then the next step up would be the liability aspect to it. And then if, God forbid, something really bad happens, that's when you have that personal umbrella or that excess liability policy to kind of give you additional millions of dollars of coverage. Again, depending on your situation, what your needs are, what your exposures are, definitely something to talk to an agent or broker about.
Yeah, we're obviously talking about this. We particularly reference the HO3 policy, but there are a lot of properties that might be in brush and whatnot. And so you'd have to discern and look at the policies between your fair plan policy, usually, if that's what you're currently being insured by, and your difference in conditions policy, which is a partner to that difference in
Companion, we call it. Officially, we call it a companion, a partner, a life partner. It needs to be together.
Well, they're partners. I mean, they basically, they help complement each other, right? So one of them covers you on the property side, and the other one comes over and covers you on most of the liabilities and other things like that would otherwise be excluded by the fair plan policy.
And the fair plan is mostly for fire, right? Brush fires and things.
Yeah.
That's why most
They
people
do offer
get it.
vandalism though, and other coverages.
You can get some enhancements. Yes, there's a couple, 3 things they give you. But again, people outside of California are like, what?
Welcome
yeah,
to California.
it's different. It's just different. But there are standalone policies, excess surplus lines, specialty companies that can, even write and brush. And we're seeing that kind of pick up a little bit. The Fair Plan is trying to reduce how many policies that they're involved in. Currently, I think they're a couple 100% oversubscribed. They probably shouldn't be writing as many policies as they are. They're taking huge rate increases.
30%.
We're kind of seeing that pendulum swing maybe to more back to the preferred companies.
Yep.
Because one thing people aren't totally aware of, but some people are, anybody that writes property insurance in California, any admitted company, they're required to participate in that California Fair Plan program on a percentage basis. So if you're State Farm or Farmers, and you got 20, 30% of the market share for homeowners policies, you're on the Fair Plan 20 or 30%. And so as a backstop in situations where they get, losses above and beyond what they're insured for. So it's kind of a complicated situation. Doesn't need to go into all the details of it.
Could you touch on that little nuance though? How the what is it? The carriers are actually a part of the Fair Plan?
Yeah, so it's kind of like there's a couple states that do assigned risk. Florida might have their own citizens insurance program. It's a little bit different. But in California, when we do the assigned risk, we call it the California Fair Plan. Essentially, they try to get everybody to participate on this risk pool. So for the higher risk properties, instead of the state of California coming in and saying, hey, we're going to backstop this billions of dollars or tens of billions of dollars, which maybe the California House doesn't have, I don't know, I'm not going to get into politics. But when it comes to insurance companies, right, they think, oh, these insurance companies have all this money that they're sitting on, so they can help absorb the cost of this. And allegedly, they're now able, with some of the new regulations that I stay out of, they're allowed to add some cost into that cost model to reflect how much liability they're assuming within the Fair Plan, within some of their reinsurance contracts, and some various other things. In the past, after Prop 13, not Prop 13, it was one of those props, Prop 210, whatever, they weren't allowed to actually charge for those things because those were kind of like a hidden cost. They weren't like a direct cost. And so when you think about it, when you're a business, you got things that you're paying for, and so the claims coming in, the claims going out, that's the cash flow you see. But then there's the liabilities you assume over the longer term that maybe you don't really know how to quantify, or it's more kind of fuzzy math, if you will. And so they tried to create it in a way where they couldn't pass on those fuzzy cost math sort of things. And then what ended up happening was I feel like the rates got too low relative to the risk in California. And now we're seeing that pendulum swing back to being, closer to parity, maybe in some cases overshooting for some people. Again, we'll see how it all plays out.
Yeah, I mean, we've seen, obviously, as independent brokers ourselves, we've seen the likes of Farmers, State Farm, as well as the Fair Plan, increase some of the pricing for the premiums on a lot of properties in their areas. And so we've been having a lot of flow of those into our business through referrals and whatnot, or through sales of properties, because, I mean, it seems like, some of them want to exit the market. We just saw Safeco, right? Liberty Mutual. They're exiting the property market in California for the most
parts of it. Yeah, it's very selective. It's very interesting. I feel like a lot of these insurance companies haven't made enough money in California, and then like with the latest fires, they lost a decade's worth of profits they didn't actually have. So when you think about it, like when you start losing money on stuff, you need to change how you're doing your business. Because it's regulated, though, it makes it harder for them to make those pricing adjustments. Eventually, they make them. It's very hard on the consumer. It'd be interesting if there was a way to kind of make it where the policyholders could actually see some policy savings or refundability or something like that. But I'm guessing the math gets really complicated, and maybe that's the rub. But yeah, it'd be nice if there was a little bit of relief eventually. But again, I think right now we're moving through the storm. It's like you're in the eye of the hurricane. Bad analogy in California, but there's no hurricane. Well, it's typhoons, anyway, but not the same as we get over in Florida and Tennessee. Not Tennessee, geez, Texas. Anyway, you know what I'm talking about. Yeah, so that's it. Anything else you want to add?
Well, no, that's definitely not it. So obviously, we're talking about Tennessee now. No, I'm just joking. So
They
in
got tornado
California,
and hail. I mean, Texas gets hail. They get hurricanes. They get tornadoes. I mean, there's some places that get these extreme weather events. In California, a lot of times with these Santa Ana winds, or just like high levels of winds with dry brush when we're in drought. Which first time in 25 years or something, we're not in drought right now, the state. So that's good, I guess. I mean, hopefully no fires.
leaps and bounds, right? I mean, one small step for California, a large step for the insurance premiums, but that's sadly not the case. So we wanted to, I would like to go back and touch on some of the fair plan details, just because a lot of people who do have homes in California are written on the fair plan. Naturally, I mean, if you have a house that's, in the middle of brush or around brush, or, it maybe not even in brush, and just a high capacity area, high volume area where there's a lot of other properties being written by the most preferred companies in that area, you might be stuck with the fair plan. I mean, is the fair plan enough by itself, Deb?
I don't think so. I mean, I personally haven't. Our clients haven't had great experience with the fair plan, to be honest. The fair plan's in a tough position, right? They had a lot of claims. They're not very profitable. They've had a lot of challenges, especially with the latest fires. It's not easy. It's not easy being an insurance company. I think it's even harder for it to be kind of a quasi-governmental kind of thing for them to be able to really operate as effectively. And they are the insurer of last resort, right? So they get the harder to insure buildings, the harder to insure locations, people that have updates in their buildings, people that have buildings that might have electrical panels that might catch fire. And there's certain things they still won't do. They're fairly selective still. And they do have requirements that trees be trimmed back. I mean, they are taking prudent risk steps. But nonetheless, I mean, they're in a really tough spot. Because again, they're not sitting on billions of dollars of capital like the insurance companies are, where they've got, claims that are being paid over time. They have some of that, but I don't get the feeling they're quite as profitable. And that's the fear for these other admitted insurance companies, right? The Safeco's, Liberty Mutuals, Farmers, State Farm, Mercury, Progressive, all the companies. They're afraid of getting dragged into having to backstop some of those claims that trickle in over time. And, so it's hard. I feel bad for the people. And obviously, we try to avoid having clients with the fair plan, but we do have a number of them with them. And, when we have a claim, we typically have to get involved in helping to advocate for them. And a lot of times we don't get everything we want, but we get some of what we want, maybe a little better than they would have gotten, without us. We've had even independent adjusters struggle to get money out of the fair plan. So it's not like it's just a unique thing to us as agents and brokers, but it is always a challenge.
It's very hard either way. I mean, regardless of the company, to get money out of an insurance company, I think we can all agree on that, attest to that. But with the fair plan, it can be particularly difficult just because, I mean, especially recently, they've been very nitpicky with the type of claims that they're responding to and will help with because, I mean, obviously it's hard to blame them when you look at it like financially with how much they've lost, but I mean, there are people.
But also the policy form. I think a lot of people think that the fair plan is a homeowner's policy. So I think you get this disconnect. And so some of the blame that they're getting or the negative stuff, I don't think it's fair. I really think that,
Fair?
Fair plan. Well, you were trying to, okay. Sorry about that bad insurance humor. You didn't pay anything for it, but you got it nonetheless. Sorry.
Not fair.
But it's hard. I mean, being an insurance company is hard even, right? They've got fiduciary duties to their shareholders. They've got responsibilities, contractual obligations to their policyholders. And then they have the reputational aspect to what they're trying to do. It's not an easy position. I think the claims department, honestly, everybody I talked to, I'm like, you got one of the hardest jobs in America, especially after the fires in Los Angeles, if you're an LA-based claims adjuster. Just the sheer level of claims, the amount of activity, the amount of paperwork, and even just how claims are handled. I think we did a show on that before, but just to kind of recap, a lot of times, they're only required to pay you actual cash value on some of your stuff until you replace it. And then you get the bump up to the true replacement cost, which, that little caveat there doesn't sound like much, but, for a lot of people, they think they're going to get $1 million check and they get a $200,000 check. I don't care what kind of policy wording you have or what kind of relationship you have. People get frustrated, right? And people get angry, and it's a challenge. I had a guy I was trying to help with a state farm plan. He had a good, decent policy. That neighbor's house caught fire, and then his caught fire. No fault of his own, or maybe it was, I don't know. But the neighbor's house caught fire, not his. Anyway, so he struggled to be organized, and I think one of the things that people also tend to not do well with insurance companies is get organized sufficiently to actually present a file to the claims adjuster in a way that they can actually do something with it. You know what I mean? If you say, hey, I don't know what I had in my house. I don't know how many pairs of jeans. I don't know how many pairs of shoes. Those are real examples of things that you have to itemize. Whereas if it's a partial loss, I've seen companies like SurfPro come in, they actually inventory everything, take pictures, inventory it. They give you a big spreadsheet. You kind of put down what you think the value of it is, and they give you the actual cash value, whatever. You get a little money. But then as you replace the stuff, you can always submit receipts and show you're paying more and above, and they have to give you that extra increase as you replace those items with your new stuff. So it just depends. But it's a long process. The best type of claim to have is the one you don't have, right? I mean, nobody wants to get sued. Nobody wants their house to burn down. Nobody wants to be in a car accident. So, don't have claims. That's my advice. Obviously, life doesn't always happen that way, but those are the reasons why.
You talk about inventorying everything. Personally, I don't know how long that would take for my wife to do if we were to have a complete loss. I think all the clothing pieces that would go missing would be, it might take a year to account for all of it.
It's the shoes for your mom, it's the shoes.
Yeah.
I don't even know. She doesn't know how many shoes she has. I talked to one of my clients, true story. He said, I don't know how many pairs of shoes my wife has, but I bought some kind of shelving system for the garage for her to organize them in. So she actually has a closet in the house of shoes and a big rack. He's talking about a rack with a couple hundred pairs of shoes on it, and some of which she's never worn. Now that's not my wife. She only has a few, ones that she doesn't wear. But I digress.
I just like to say on the record right now that in the event of a total loss, where, let's say my parents' house burns down, I am estimating that there is a total of 40 pairs of shoes that my mother owns, all of which half of which are running shoes that are probably used and irreplaceable to her heart. But, we might be able to take $200 to $300 for each of those pairs if you're the insurance company. So, again, we're just making sure that...
Now, that's another interesting conversation to have, though, son. It's about padding of claims and insurance fraud. We're not advocating for insurance fraud. We're just here trying to tell people that, it's hard to remember exactly what you had. So the cool thing now...
a mental list, a mental note, and
pictures,
anything, just
videos,
thinking about
once a year. Take your camera around your house, open your cupboards, open your drawers. Just take a picture of what you have. And, later on, who knows? Was that 20 pairs of underwear, 50 pairs of socks? Whatever, again...
If it really matters, you can go through the video and you can count some of it up and you can get a proper estimate.
You'll never, hopefully, let's knock on wood here, you're never going to have to deal with this, hopefully. But if you do, and you got a video, you got something better than nothing.
It takes a couple minutes maximum for you to just walk around.
Once a year.
You
got your
don't have to
Amazon
fold around.
purchases.
Exactly. 2 minutes. Once a year, you're able to inventory all of your stuff. Especially if you're in a high fire
Maybe 15 minutes in our house with the closets and stuff and the shoes. But if it wasn't for the shoes, it'd be easy.
If it wasn't for the shoes, this would be a 20-second process. You'd click record, go around a little bit, but with the shoes, you have to go one by one. Obviously, we're just joking and digressing here, but it is very important that you do have either a mental note or a physical, copy of what
pictures
what
worth 1,000 words. I'm telling you, a video might be worth 1,000,000. Honestly, just a quick little walkthrough. And the time to think about the things you want to keep is before the fire happens. To be honest with you, you need to think about those heirlooms. It's interesting. A lot of people that have a loss, first thing they think of is, I want to keep my fanciest stuff. You know what I mean? Yeah. But after the event, they look back and they go, actually I miss, my dad's this or my grandparents that. You know what I mean? Or the wedding, album or something like that. Things that are harder to replace. Now things are digital online. All the pictures, I guess. But still, there are certain things that are family heirlooms that really matter to people. The challenge is you don't want to keep them stored in a safe somewhere off site where you can't be around them. Where's the pleasure in that? So I don't have a good answer, people.
Yeah, I mean, at least for some of the things, right? You're talking about like wedding stuff. Like if you do have a wedding ring that's fairly expensive, or if you do have some things that you feel have higher value, then it might be on your personal property on your insurances. There's a thing called scheduled items that you can talk to your broker about or your insurance company about, and see if you can add some of those scheduled items. Make sure that those are listed on there. We see jewelry, we see furs, things like that. I mean, some
Artwork. Some of these
yeah.
paintings. Have you seen how expensive? One of our clients has like a
That's
$5 million painting.
topic. Well, obviously, depending on the value of your artwork, you might need other additional insurances, like inland marine, if it's going to be transported or things like that, or moved from a location to location, or just in general. I mean, just the sheer like value of some of the things that people have that they don't realize. I mean, you could have a ring that's from the 1900s or whatever that you got because it obviously you got proposed to, and it could be worth $100,000 or something like that. And if that's not properly written on
Very few clients have that kind of stuff. But
of course, I'm just
people
saying. Well, let's say you thrift it. Let's say you thrift
collections,
something like that.
coin collections.
We found shoes. We found shoes at the Goodwill bins back in the day when it was my father and I that were worth $500 to $600, right? I mean, and they if you have shoes like that or pieces like that, and it might not be adding up to what your personal property or your other coverages are on your insurance policy, it is important to make sure that those things are scheduled. And so again, it takes a couple seconds. Walk around, inventory your stuff. If it seems like there's something that should be noted on your policy that's of particular value to you, maybe write it down, talk to your insurance broker about it, talk to your insurance company about it, make sure that it is.
A lot of times you got to get appraisals, don't forget, right? A lot of these things, they don't take your word for what it's worth. They want to actually have an appraisal too. So things like watch collections, jewelry collections, coin collections, stamp collections. I mean, now people might be having silver and gold or whatever. Like, there's always sublimits on a lot of these policies that are very, very low, like $5,000, $10,000. And it's not very hard to be, have stuff, multiple times that. So again, if you want to self-insure, that means you don't have insurance from the insurance company. If you get a loss, you get nothing. Your mom lost her wedding ring and, it was sentimental. It was not inexpensive, but it wasn't super expensive. So she got a new one, right? But it wasn't insured, it wasn't scheduled, and we didn't file a claim, and so, but if it were more expensive, probably would have been better to have that scheduled and have that properly insured.
There are a lot of things that are also on policies that a lot of people don't know about. I mean, the option to schedule, probably one of them for some particular, for some people who do have, like you say, watch collections or at least like a ring or something like that, that's an option to schedule. There's also like fences, right? And things like that. I mean, if you don't realize how much it costs to replace a fence until you replace a fence, a gate, right? I mean, shrubs, trees, right? There are different sublimits that are on your policy that, I mean, if you have a lot of them, I don't know if you've got a big garden out front or something like that, or whatever.
But again, you have to realize that they're not insuring your garden to grow. What they're insuring it for is in the event of like a major fire that goes through and burns it all down. It has to be a covered loss, right? It has to be a covered peril. So like things like, having it just there, it does have value, yes. A lot of people don't realize that, like a lot of the fires that have happened around, in LA, it's not just the loss of the home, but it's the loss of the landscaping.
Yep.
And a lot of landscaping is actually underinsured. Companies, they want you to wait the 30 years for the big tree to grow, I guess. But it is something to contemplate and make sure you're aware of what you have, what you don't have, what you're insuring for, and what you don't need to insure for.
Again, I mean, just the property side, just your personal property, just go take a look around your house. If you own the house, then go outside the house. Let's make sure that it's in good condition. If it's in pristine condition or you recently got an update, please tell your insurance broker that you might be eligible for a credit, right? We're going to also recommend that you get a water shutoff device, especially for those people who might be prone to leaks or have, some plumbing that, has historically maybe had some issues, which obviously is a completely different thing that we don't want to go down the rabbit hole of poor plumbing. But, a water shutoff device, you might be eligible for a credit there. Recording, as we said, the video, and also scheduling stuff on your policy that is either important to you, of value, or in the event of a loss, it might not be covered if you don't talk to your insurance broker about it. And I mean, having an insurance broker and having a relationship with them and your company, making sure you're paying your bills and making sure that you're keeping them in the loop on things that are happening with your property. If you're adding an ADU, all of a sudden and it's attached to the building, all of a sudden you're under renovation. That's something that should be known. I mean, then you should be probably covered for a course of constructions if you're adding an additional dwelling unit, right? There are things that are really important to keep people in the loop on. I mean, insurance obviously doesn't come top of mind, but the second that you start thinking about big changes to your property or in your life, we should be, or whoever your insurance broker is, the first or second person that you call for advice.
Again, if you're getting married, you're getting divorced, having a kid, pretty much everything you think about. You've either got to get them on the health insurance if they're getting born. You've got the divorce issue of trying to figure out who gets what car, what property, what liability policy, making sure all that stuff gets aligned correctly. And then you've got, if you get married, add them onto your policy, making sure that the insurance policies are structured properly together to protect you regarding, who's in what car. Again, there's just so many things that get into like specifics to people's lives and that we can give unique advice on. Again, but everybody's situation is unique. So yeah, definitely do that. The last thought I have too is take out your policy and try to read it or look at it. At least get a gist of how much coverage you have for your building. How much coverage
Declaration
you
page.
have. What's that?
Just the declaration page. We're not asking you to read the whole policy form.
Not the whole thing, just the numbers. Just look at the numbers. Yeah, coverage A, coverage B. Look at that. Get a feel for it. Look at your deductible. Some people have a $3,000 to $5,000, $10,000 deductible, and they want a $0 deductible. Or some people have 0, and they should have $2,500 or $5,000. Again, just take a look. It may not be a huge cost savings either way, but again, we do recommend not filing even small nuisance claims. If it's absolutely necessary, you do it, but if it's not necessary, you don't. Again, just talk to your agent or broker, okay? Thank you so much.
Yep, and the next podcast, I know that this was definitely emphasis on personal property. Next podcast, we're planning to be talking about auto insurance. So for those of you who have seen, massive rate hikes in your auto insurance premium, and have questions about coverages or things like, hopefully it's about coverages and not pricing, then we'll be touching on that in the next episode as well,
including the idea of making sure you have young drivers, 16-year-old drivers, doing illegal U-turns. But we'll talk more about that next time.
That was a personal experience that I had. This is a attack at the end of the episode. This is what is this? An uppercut? No, what
jab?
Is it? No. It's a sucker punch. Sucker punch. There you go.
Sucker punch.
It's a sucker punch. But we're going to be addressing these accusations in the next episode about your personal auto insurance and about 16-year-old drivers who are driving a Mustang and do an illegal U-turn and scrape the side of a parked car with nobody inside of it and have a whole shebang.
Story.
Parent.
There's a story. There's a story there. We'll talk next time. Thanks so much for your time.
Bye.